Hey guys, it's Sasha. Today we have to talk about the pound. In the last few days, the British pound has collapsed spectacularly, plunging the UK economy into an unprecedented crisis. The pound has collapsed by 4% immediately after the new emergency budget was announced on Friday and has been incredibly volatile, swinging by 5% in trading yesterday. The new UK Prime Minister Liz Truss was elected as Prime Minister just 20 days ago and had 2 weeks out of the spotlight while the media was focused exclusively on the death of the Queen. Eventually, the newspapers woke up and remembered that the UK is actually in the middle of the worst cost of living crisis in a generation and the biggest energy shock in 50 odd years. And the moment attention turned to Liz Truss, she decided to go ahead and wreck the UK economy by passing an emergency budget that absolutely nobody asked for. 2 weeks before the emergency budget, Liz Truss announced a cap on energy prices in the UK. This cap means that the average household will only have to pay £2,500 a year for electricity and gas from the 1st of October. I am using the word only somewhat loosely here. The slight problem with this plan is that it is not a decree that forces energy companies to reduce their margins, to stop profiteering, maybe even have to take a loss. That would of course be completely unfair to large UK energy companies like Centrica, who by complete coincidence increased their operating profits by 400% last quarter before the UK energy bills increased to the new price cap in 4 days' time. The big problem with the price cap is that the energy companies still get to charge whatever it is that they want to charge for gas and electricity, and the UK government will just make up the difference between the price cap and the actual prices. And this is obviously great news for the energy companies because the UK government is a little less price sensitive than the typical consumer, which is why the Institute of Fiscal Studies has calculated that this policy will cost the UK more than £100 billion. That's about £1,500 per person in the UK, and about 50% more than the total cost of the furlough scheme implemented during COVID. This price cap is not means tested or in any way linked to the taxation system, which would potentially have drastically reduced the total cost of the program to the UK taxpayer and made a whole lot more sense. But why stop and think about what you're doing if you can just go and do it instead, right? It's not clear whether Liz Truss is aware that money does not in fact grow on trees, because there are only two real options available to the UK government to fund the scheme. The first option is to print more money. The policy has been very popular over the last couple of years that has the unintended consequence of creating a massive inflation problem. And when inflation is already pushing the 10% mark, printing even more money than you did before that caused this inflation in the first place might not turn out to be the best idea if you don't want to accidentally spiral into hyperinflation. The other option is to recoup the money through increased taxation. And of course on Friday, Kwasi Kwarteng, the new UK Chancellor, delivered an emergency budget where he slashed every tax that he could remember. Corporation tax increase has been cancelled, national insurance increase has been reversed, basic income tax is dropping from 20% to 19%, the top tax bracket of 45% is being removed altogether. Because when you're right in the middle of one of the worst financial crises in modern history, people on over £150,000 a year of course need that little bit extra help on top of what everybody else is getting. By the way, if you happen to see a homeless person on the street freezing cold in the middle of winter and you want to help them, get in your car and drive to Mayfair. Then stick a £10 note through the letterbox of a mansion on Grosvenor Square, and trickle-down economics will mean that it will eventually buy that homeless person a sandwich. Anyway, the rest of the world has looked at the UK pressing the self-destruct button with the economy and got somewhat confused. The UK government is stimulating the economy at a time when the entire rest of the world is tightening their fiscal and monetary policies. UK unemployment is at a historically low level of 3.6%, which is the lowest level since January 1974. But at the same time, 82% of adults in the UK said that they were very or somewhat worried about the rising cost of living, according to the Office of National Statistics. 87% said their cost of living increased in the last month, and half of all adults are seriously concerned about being able to pay their energy bills. At the same time, 29% of businesses in the UK expect to increase their prices next month in October, heaping even more pressure on people making ends meet, and inflation-adjusted wages, the light blue line on this chart, have declined at the fastest rate in living memory. I guess Liz Truss thought that the British public would be maybe appreciative of a tax cut of 1% coming in from April next year, but instead the value of the pound has collapsed by 8% in the last month and 20% year to date. These numbers are bonkers. This latest collapse is likely to result in more inflation from October as the price of all imported goods and services and energy becomes even more expensive in pounds. The Bank of England has only just increased the rates by 0.5% to 2.25% and now have a Mexican standoff with the government. You'd think that at a time of a major national and international crisis, those two would maybe consider working together. But it seems that the UK government is busy punching the economy in the face at the exact same time the Bank of England is trying to apply CPR. Energy costs are going to explode in October. A sharp reduction in the value of the pound means that many other goods and services will also go up sharply. And the next time the Bank of England committee meets in November, I know, it couldn't possibly go and meet before then, people have a busy schedule, they may be in an impossible situation. They're ruled out doing an emergency increase before that meeting, so we have time for things to get even worse. Inflation is likely to look pretty ugly, and rates will have to go up considerably, maybe not all in one go at that meeting, but over the coming months. And a shock increase of 1% or more, which is becoming increasingly likely, may also plunge the UK into a deep recession or worse. The UK government debt is at £2.4 trillion as of the end of August, and that is equivalent to 97% of the UK GDP. And the cost of borrowing to the UK government has just exploded. The 10-year benchmark yield has increased by 1.26% in September so far, the highest monthly increase in recorded history. And for every 1% increase in the base rate, the increase in interest owed on the debt by the government goes up by roughly 1% of the country's entire GDP, so there's that to think about as well. Worse still, the total size of private and corporate debt in the UK is 4 times as big, and as the rates are pushed upwards, the cost of servicing this debt can quickly push people into financial difficulties and cause bankruptcies. Over a dozen UK mortgage companies have halted offering mortgages this morning in a panic move, including Virgin Money, Halifax, and the Skipton Building Society. They are concerned that the Bank of England base rate will start emergency hikes despite the public announcements, and they're worried about the state of the UK economy. If this situation persists, the UK may well add a house price crash into the pile of excrement that is the state of the UK economy at the moment. Many investors are looking at the weak pound and wondering what they should do. As the value of US stocks has been falling this year, the falling exchange rate means that the value in pounds has looked a whole lot better. Some stocks that have fallen in dollars are the same or even higher in pounds as they were at the beginning of the year. And a very common question at the moment is, should you take advantage of this low exchange rate? What if you stay invested in US stocks and the pound goes back up to 1.5 to the dollar? Should you invest in UK stocks while the pound is so low? Because, the pound will probably go back up, right? Well, the last general election in the UK happened in 2019. And that means that the Conservatives have until January 2025 to hold the next one. Although a few MPs have apparently already written letters of no confidence in Liz Truss some 20 days after she took office, it is unlikely that we are going to get rid of the Prime Minister a few days after they've wasted 2 months picking the new one in the first place. It is likely that the ramifications of the plan they just announced last week will unfortunately have to play out. As with other things like the stock market, past performance is no indicator of what the future will bring. Just because we got used to having the pound at $1.4 to $1.5 or $1.2 to $1.3 in the past does not mean it will go back up to that same value. If the UK government continues with the policy of fiscal harakiri, it could go down further still. And as a long-term investor, gambling on currency movements is a game that can turn sour very quickly. In the long run, fundamentals of outstanding companies are far more important and yield far better results than trying to time and guess short-term movements in anything, including currency exchange rates. But at the same time, we are in completely uncharted waters, so who knows which way this one is going to go. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and I'll see you guys later.